Hey everyone, welcome to today's subject. We're going to talk about which funds are right for you. This is an excellent question for you to ask your advisor. Getting the right kind of asset allocation time in your portfolio is very, very important. And I'm going to go through this in less than 10 minutes. We're going to really fast. It's a lot of content, so I apologize if I'm going too quickly, but just ask me any questions you have in the comments below. Send me an email or give me a call. All my information is available in the description of the video below. Okay, so what is the difference between a mutual fund and a segregated fund? Why would I be in one or the other? People say, why would I invest in segregated funds? Those are too expensive as compared to a mutual fund, or mutual funds don't make any money, or RSPs don't make any money. I get all these questions all the time. We're going to go through that real fast so you can understand what's going on. A mutual fund is regulated by the Bank Act of Canada, segregated fund by the Insurance Act of Canada. That's why you cannot buy a segregated fund at a bank. You need to have an insurance license to sell segregated funds. Mutual funds have lower MERs, management expense ratio. That's what MER stands for. It's really the cost to you. What does it cost to invest in that particular fund? A segregated fund has the same cost or higher. I'm going to get into how that is right now. But let's dig into 6 funds. These are 6 segregated funds offered by 6 different companies. What are their costs? What are their rates of return? And you're going to say, wow, that's so high. What's going on? Let's look at the first one, Canadian Dividend Fund offered by RBC. Sure, I should say first that all these funds are Canadian Dividend Fund with a 75 to 100% guarantee level and like 95% weighting in Canada. So we're trying to compare apples to apples. Again, they're all dividend fund, all segregated funds. So I want to make sure we're talking about the same thing here. The 2.32% for the RBC fund, that's the MER, the cost, a 5-year return of 5.61. The Canadian Dividend Fund, this is managed by Great-West Life, 2.7%, a 5.1% rate of return. The Canadian Dividend Fund offered by Mackenzie Financial, 2.9%. It's a relatively new fund, so there's no 5-year guarantee. You'll notice those 2 funds are offered by Canada Life and Freedom 55. So if you're investing with either one of those companies, here's your fund performance, at least the MER and the 5-year return, okay? And again, I'm just trying to use this as a comparison model to get through an education here for you. Industrial Alliance, 2.9%, 5.1%. Bank of Montreal, 3.07%, no 5-year return. Kind of interesting, Bank of Montreal has ETFs as their underlying security in this fund, and yet, it's kind of a higher rate of return. I was kind of surprised, or cost to you rather. Manulife Fidelity is 3.5 and a 4.2, so highest among all of them and the least return available. Let's look at why mutual funds, segregated funds. So an ETF has the lowest cost, under 1%, somewhere like 0.2 to 0.5, okay? A mutual fund fixed income fund is going to have somewhere around 1.3 to 1.5% MER. An equity mutual fund, about 1.7 to 2.1, maybe 2.2 maximum. A fixed income segregated fund is somewhere, it's obviously over 2%, and as high as say 2.4, 2.3%. We just ran through the equity ones, 2.3 to 3.5 easily. Now, how do you get lower MERs with a segregated fund? When you deposit more money in a segregated fund, most of the companies vary, but let's say 250,000 to 400,000, they're going to offer you a lower MER. That MER is actually very competitive to an equity mutual fund. So you could have the benefit of having a lower MER, but getting all the guarantees you would get with a segregated fund. And what are those guarantees? Why are they so important? If the fees are so much, not so much, but higher than a mutual fund, why would somebody go to a segregated fund? Let's talk about those things. On the left, you have a mutual fund. That mutual fund runs up over time, has some good gains, and then we have a correction. It doesn't matter what kind of correction. It's a pandemic, a recession. Anyway, the market balance is much lower. Person passes away. Their beneficiaries, their heirs are going to get whatever the market balance is. I'm not going to get into the weeds about this is a couple, and it's an RSP, an automatic rollover. Forget about that. We're just basically saying, like, on principle, we're talking about that the balance is what's going over to that individual, the market balance. On a segregated fund, the insurance company is going to top that back up to what it was before the decline. So that's an interesting concept, isn't it? That's why you're paying that fee. That extra fee is for the insurance protection of your money, to make sure that as markets increase, you protect your gains going forward. You don't get that with a mutual fund. So let's talk about who that might be useful for, because this is also important. If you're thinking that we're not going to have any major declines, let's look at the last 2 decades. Awful stuff here. Negative 35 with the dot-com bubble bursting, followed by 9/11 minus 20%. Ran up, really glorious time of the markets. And then we got hit with minus 45% with the world financial crisis. The markets ran up, minus 18 decline again with the U.S. down, the credit down rating. Markets ran up. We got hit with a minus 16 on China GDP slowing down. We had basically Europe was doing very poorly, Greece defaulting on their debt. U.S. election happens, markets run up again. Coronavirus in 2020, minus 33%. Awful, right? And one thing I would point out to you is, if you look at 2008, it took until about mid-2014 for markets to get back to what they were in 2008. If you were retired, if you had money that you were counting on to live on, that was an awful period for you to go through, because you were wondering, am I ever going to get my balance? Especially if you're taking money out during this time, it depleted your portfolio in a great way if you're in a mutual fund. But in segregated funds, you had your money protected, which was an awesome thing. Can we all agree over time, money will go up, that the markets will always go back to and exceed the previous highs? But you have to live through these things, these major declines. This is extreme volatility. And so segregated funds are going to help you to manage your portfolio during market volatility. It's going to protect your money from loss during these times, and that's because they have guarantees. You can choose between 75% and 100%. Let's talk about estate planning benefits with segregated funds and mutual funds. No estate planning benefits at all. Zero. Segregated fund, massive benefits. In a mutual fund, you're going to pay probate. When a person passes away, 1.5% over $50,000 is going to be the cost of probate. That I'm not going to talk about, well, it's an RSP and it's a rollover and all this. Let's just talk about what are the rules, okay? In a segregated fund, because there are certain things you can do to mitigate some taxes, like having joint accounts and non-registered accounts, that type of thing, having beneficiaries instead of your estate. Let's just talk about what the rules are. In a segregated fund, your money actually bypasses your estate. So that means doesn't make up part of your will. There's no estate fees, because it goes directly to the beneficiaries that you have. Probate takes about 90 days in Ontario, so it takes about 90 days in a mutual fund for that to be probated, so that your executor can disperse the money. Whereas in a segregated fund, right away the money goes to your beneficiaries, no delays. And so if your beneficiaries are counting on that money to live, they don't want to wait 3 months to get their money. They want their money right away. They need it, right? Beneficiaries in a mutual fund, first has to be the tax return. So you've got a personal tax return, you've got a terminal tax return, you've got to pay all your creditors first, you have to do your probate, and then you can do the disbursements to the beneficiaries. In a segregated fund, nothing like that. It goes straight to that beneficiary right away. So again, mutual fund, CRA, Canada Revenue comes first, and creditors come first. In a segregated fund, beneficiaries come first. So why would somebody choose one or the other? You start to see a picture of who would want. If you were maybe younger, you would maybe want to be in a mutual fund because the fee is much lower, and that would cost you money over time. But as you get older, you'd want to move your money to segregated funds to protect the assets, to protect from all these delays that we're talking about. Very important. Privacy is among the one thing that I think is most important in segregated funds. If you're older and you have money, if you're considered one of those high net worth people, you have complete privacy. It bypasses probate. It's not part of your will, which is a public document. Public documents, people can see how much money are going to your beneficiaries. That's why segregated funds are so terribly important. No one will ever see how much money you're giving your kids. Well done. We got under 10 minutes. Look forward to seeing you in the next video. If you have any questions, put them down below. Send me an email, give me a call, and I hope you're having a great day. We'll take care. See you soon.